Right now, $2.1 trillion is quietly moving through the global financial system. Not over months, not over decades, but right now. And almost nobody is paying attention. This isn't government stimulus. This isn't a bailout. This isn't a stock market rally. This is BlackRock, the largest asset manager in human history, the firm that controls more money than the GDP of most countries on Earth. And today, BlackRock is executing a capital shift so massive that if history rhymes the way it always does, the US economy may never look the same again. Here's the part that should make you uncomfortable. When smart money moves this quietly, it's never chasing opportunity, it's running from risk. And the question you should be asking yourself is simple. What do they know? Or that you don't? Because if you're still thinking this is just another Wall Street rebalancing, then you've already missed the warning sign. Let's rewind for a second. Every major economic collapse in modern history shared one terrifying similarity. Not panic, not headlines, not even crashes. It started with silent repositioning. Before the Great Depression of 1929, America looked unstoppable. Stocks were soaring. Credit was easy. People were buying assets with borrowed money, convinced prosperity was permanent. But behind the scenes, the biggest banks were pulling liquidity. Insiders were selling. Capital was quietly rotating out of risk. By the time the public noticed, it was already too late. In 1997, before the Asian financial crisis, foreign capital didn't flee overnight. It left slowly, stealthily, currency by currency. Then one peg broke, then another, and suddenly entire economies collapsed in weeks. In 2007, before the global financial crisis, Wall Street said everything was contained. Housing was stable. Risk was diversified. But the smartest institutions were already offloading toxic exposure. They weren't predicting a crash. They were preparing for one. And when the system finally snapped, trillions evaporated. Jobs vanished, savings were wiped out, and the middle class paid the price. Now here's the uncomfortable truth. The same pattern is forming again. Different assets, different language, same behavior. BlackRock isn't just another investment firm. It manages over $10 trillion globally. Its Aladdin system monitors risk across thousands of institutions, governments, and markets in real time. When BlackRock moves, it's not speculation, it's signal. And right now, that signal is loud, if you know how to listen. Over the past year, BlackRock has been shifting over $2.1 trillion away from traditional U.S. market exposure and into areas most retail investors are still ignoring, misunderstanding, or laughing at. Private credit, infrastructure, energy transition assets, real assets, tokenized funds, hard collateral. Not growth stories, survival positioning. Ask yourself this. Why would the largest asset manager on Earth reduce reliance on U.S. public markets at the exact moment when headlines scream soft landing and economic resilience? Because the real danger never announces itself. It builds quietly under layers of debt. Right now, the United States is sitting on over $34 trillion in national debt. Interest payments alone are exploding faster than defense spending. Every rate hike doesn't just slow inflation, it strangles the government itself. For decades, America survived by exporting inflation and importing cheap capital. Foreign buyers absorbed U.S. debt. The dollar stayed dominant, the system held. But here's what changed. Major foreign holders of U.S. treasuries are no longer buying at the same pace. Some are selling, some are diversifying, some are stepping back completely. That means someone has to absorb the debt. And increasingly, that someone is the Federal Reserve, which means more money creation, more balance sheet expansion, more long-term currency dilution. Now pause. If you were managing trillions of dollars, would you keep a heavy exposure to assets priced in a currency under structural pressure? Or would you quietly rotate before the public connects the dots? This is where things get uncomfortable, because BlackRock isn't just reallocating capital, it's redefining what counts as safe. For decades, safety meant U.S. treasuries, public equities, dollar-denominated assets. Today, safety means control, collateral, and cash flow, private infrastructure that governments can't print away, energy assets tied to real demand, credit structures with seniority and protection, and increasingly, assets that exist outside the traditional financial plumbing. This is where crypto enters the conversation, not as hype, but as insurance. BlackRock didn't file for a Bitcoin ETF because it believes in decentralization. It did it because Bitcoin is uncorrelated, scarce, and borderless. In other words, a hedge against systemic stress. And history tells us something important. When institutions begin treating alternative assets as protection instead of speculation, the system is already fragile. But here's the part most people miss. This isn't happening because BlackRock is bearish. It's happening because the structure of the economy is changing. Debt-driven growth is reaching its limits. Demographics are shifting. Globalization is reversing. Supply chains are fragmenting. The old playbook doesn't work anymore. And when the playbook changes, Those who keep playing the old game lose first. Let me ask you something directly. If everything was truly fine, why is the world's biggest money manager preparing for instability? If markets were truly safe, why move trillions into illiquid, long-term hard assets? If the dollar was untouchable, why build parallel systems? This isn't fear-mongering. This is pattern recognition. And patterns always repeat until they break something. We are currently in the early stage of every major financial reset in history. Not the crash phase, not the panic phase, the repositioning phase. This is when smart money moves first, quietly, strategically, while optimism is still high. This is when the biggest fortunes are protected and the biggest losses are unknowingly locked in. Because once volatility explodes, choices disappear. Liquidity dries up, prices gap, governments intervene, and the average investor realizes too late that they were never meant to win this phase. But here's the most important part. This story doesn't end in destruction. It ends in selection. The system doesn't collapse evenly. It filters. Those with leverage suffer. Those with flexibility survive. Those with optionality thrive. This is where you need to pay very close attention. Because BlackRock's $2.1 trillion move isn't about predicting doom. It's about positioning for outcomes. High inflation, low growth, currency volatility, geopolitical fragmentation, not one scenario, multiple scenarios. And that tells us something powerful. The next decade won't reward blind optimism. It will reward prepared minds. Right now, you still have time. Time to reduce bad debt. Time to build liquidity. Time to diversify beyond headlines. Time to invest in skills, not just assets. Because when the next phase arrives, it won't announce itself. It will feel sudden, but it won't be random. Every financial collapse follows the same invisible script. Not because history is lazy, but because human behavior never changes. The only thing that changes is the disguise. First comes denial, then confusion, then panic, then reset. And almost everyone realizes what's happening, one phase too late. Let me walk you through this slowly, because once you see the pattern, you can't unsee it. The first phase always begins quietly. No crashes, no screaming headlines, no red candles. This is the phase we're in right now. Capital starts moving behind the scenes. Institutions reduce exposure. Risk gets repriced silently. Liquidity doesn't disappear. It just becomes selective. This is when smart money stops asking, how much can I make? And starts asking, what can I afford to lose? That's why BlackRock's move matters so much. Because when trillions reposition during calm conditions, it means the risk is structural, not cyclical. It means the danger isn't a recession, it's a systemic imbalance. The second phase is where most people get trapped. This is when markets become volatile, but not broken. Prices swing violently, narratives change weekly. One month it's rate cuts are coming, the next it's rates higher for longer. Retail investors chase rebounds, buy the dip, sell the fear, repeat. But here's the trick. Volatility is not opportunity when liquidity is shrinking. It's a transfer mechanism. This is when wealth moves from emotional hands to patient ones. This is when pensions underperform, ETFs misprice risk, and leverage quietly becomes lethal. And this is exactly why BlackRock is prioritizing assets that don't depend on daily market confidence. Private credit, contracted cash flows, real infrastructure, assets that don't need optimism to function. Now comes the third phase. This is the one nobody believes. Until it arrives. This is when something breaks. Not everything, just enough. A bank, a currency, a bond market, a geopolitical flashpoint. It always looks isolated at first. Contained, idiosyncratic, temporary. Until suddenly, it's not. Liquidity freezes, credit spreads explode, governments step in, and this is where the average investor realizes something painful. They weren't diversified. They were concentrated in the same system. Stocks, bonds, real estate, all priced off the same assumptions. Growth, stability, trust. And when trust cracks, correlation goes to 1. This is why BlackRock's positioning is so revealing. They're not betting on collapse. They're hedging against loss of confidence. Because confidence is the real currency. Once it's gone, printing money doesn't restore it. Which brings us to the final phase, the reset. This is where the rules change. Debt gets restructured. Currencies weaken. Purchasing power resets lower. But here's what nobody tells you. Resets don't destroy wealth evenly. They reprice it. Those holding cash with no yield lose silently. Those holding debt-heavy assets suffer publicly. Those holding productive, scarce, or flexible assets emerge stronger. This is why every major crisis creates a new elite. Not smarter people, prepared people. Now let's talk about you, because none of this matters if it doesn't change how you act. You don't need trillions. You don't need inside access. You don't need to predict the exact trigger. You need positioning. First, liquidity. Not as an investment, as an option. Cash gives you flexibility when others are forced sellers. It gives you time when panic removes choices. But here's the mistake most people make. They sit in cash forever and let inflation bleed them slowly. Liquidity must be temporary and intentional. Second, debt. This is non-negotiable. Bad debt is a ticking time bomb in unstable systems. Variable rate loans, high-interest consumer debt, leverage tied to optimistic cash flows. In volatile periods, debt doesn't just magnify returns, it magnifies mistakes. The smartest move is boring and incredibly powerful. Reduce exposure to obligations that depend on perfect conditions. Third, diversification, real diversification, not just different tickers, different risk drivers, assets that respond differently to inflation, deflation, and volatility. That might mean real assets, alternative income streams, selective exposure to digital scarcity, not because it's trendy, but because systems fail at the margins first. Fourth, skills. This is the most underrated hedge of all. In every crisis, asset prices fluctuate wildly, but skilled people adapt faster. The ability to earn, pivot, consult, create, or solve problems is more valuable than any single investment. Capital follows competence, always has, always will. Now let me say something uncomfortable. Most people won't do any of this. They'll stay invested the same way because change feels scary. They'll wait for confirmation because responsibility feels heavy. And by the time certainty arrives, the opportunity will be gone. That's how cycles work. Not because people are stupid, but because comfort is addictive. BlackRock isn't immune to fear. They're immune to illusion. They don't need optimism. They need resilience. And that's the lesson hiding inside this $2.1 trillion move. This isn't about the U.S. collapsing. It's about the U.S. changing. It's about a world where money is more expensive, growth is harder, and mistakes are punished faster. A world where passive assumptions no longer work. But here's the empowering part. You're early. Not early to a trade, early to awareness. You're seeing the shift before panic forces reaction. And that alone puts you ahead of most people. Because the future doesn't belong to the loudest voices or the boldest predictions. It belongs to those who prepare quietly while others argue loudly. And in the next video, we'll go even deeper. We'll break down which assets historically survive resets, how governments respond when debt becomes unmanageable, and how to position yourself for the next decade, not the next headline. Because this story isn't ending, it's just entering its most important chapter. And the question isn't whether the system will change, the question is, will you be ready when it does?